Hello and welcome to the video for Workshop 1. We are off and running in Accounting 201. There's a couple things that you would want to have handy in front of you as we go through this video. The first one is a curriculum guide. It starts out Workshop 1. This is in the course materials folder under Workshop 1. And the second one is the study guide that I have posted in the facilitators forum. We'll go through that in a minute. But first to the curriculum guide where it lists the activities starting on page 2. Activity 1, make sure you post a bio of yourself. Tell us a little bit about yourself. Some of you have already done this, but feel free to post a picture. There's a way to do an attachment on there and put a picture of yourself or your family if you'd like, so we can put a face with the name. Any other hobbies or interests that you have. Get to know your classmates in the bio section because you will be taking a number of courses together as you enter this program. So let's start out and get to know each other and build a little community. Would love to get to know you a little bit better through the bio forum. Second one, Activity 2 is supplementary materials. These are optional. This is the textbook site where you can go to that link and they have some PowerPoint presentations, some study guides, outlines, those type things. If you would like to have some supplements to your material, all that is available. Even they even have a little practice quiz that you can take. If you're struggling through the chapter, feel free to go there and get a little extra help. Activity 3 is a reading assignment, obviously in your textbook, the Wild Book. We're looking at chapter 1 this week. Begin collaborating in the discussion forum, talking about the problems that you're having, answering each other's questions as they arise. That's 40 points out of the grade per module, so make sure that you're actively checking and posting a couple times a week would be good to get those points. I'm pretty easy as far as getting and giving credit, but make sure that you're available and involved during the week. Make sure you have your Connect set up. Hopefully you've already done that. If not, there's the information under Activity 5 to go and register. That's where we're going to be doing our quiz and our homework problems. There is no quiz for Workshop 1. That'll be in Workshop 2 where we'll do a quiz for Chapters 1 and 2. But we do have Connect problems in this first workshop. So you want to make sure that you have that set up. And I would recommend doing the problems after you get through the reading and looking at the studying guide. And as you're progressing through the discussion in the class forum about Workshop 1, use the discussion to help you with the problems as you're having trouble. So under Activity 6, those are listing the different exercises and problems that are required that will be done in Connect. And we'll get back to the devotional reading at the end, but let's go to the study guide. And I've basically outlined Chapter 1 for you, talking about the key concepts that you'll need to do. This isn't a replacement for reading, so make sure you read and have this handy as you go through, but I feel like this will be a helpful supplement to your reading and help guide you a little bit. So what is accounting? First is the process of identifying, recording, and communicating information about an organization's activities. So we're bringing all the information together, presenting it in an organized fashion for decision makers both inside and outside the company. So who uses accounting information? There are external users outside the company wall, so these are shareholders, creditors, like if you go to the bank, they're outside the company, but they use the financial accounting information that you present. And there's also internal users, so these are the internal managers, the executive officers who see the budget numbers and actual numbers as they come in. So when you hear the term financial accounting, that is more geared toward the external users. The term managerial accounting is all geared towards the internal users. So I guess the book is called Financial and Managerial Accounting. The first half is kind of more geared toward the financial side. We get into a little bit of managerial accounting towards the internal users in Accounting 202 in the second half of the book. You'll hear the term GAAP. What does GAAP stand for? GAAP is Generally Accepted Accounting Principles. And what that is a common set of standards that everybody is required to record their transactions and financial statements with. So we're trying to get Company A and Company B using the same exact standards so we have some comparability. If one company is using this type of standards over here and another one is using these over here, they might not be able to match up, and we can't really tell how the operations of the company went or how their financial position is. So we're doing kind of a same set of generally accepted accounting principles so that they match up and we have some comparability. The FASB is the Financial Accounting Standards Board. You can go to FASB.gov and look at their pronouncements. They're the ones that issue the GAAP. The SEC is the Securities and Exchange Commission. If you're a public company, there's a lot of reporting and regulations through the SEC that you'll have to deal with. But they supervise public companies and on behalf of shareholders, they are the government who oversees corporations. Now we get into key principles and assumptions within GAAP. We'll go through a couple of those real quickly. The cost principle says you record transactions at cost. So if you buy a computer, the example I gave you in the study guide, you buy it at $2,000, but management feels like it was a deal and it was really worth $2,500. Well, what we think it's worth really doesn't matter. We take the receipt for $2,000 and we're going to record it on our books at $2,000. So that's the cost principle. Revenue recognition kind of tells you when you record revenue. The general idea is when it's earned. So if we have an agreement and we deliver the product, even if we haven't received the cash, we're going to go ahead and record our revenue. The third one is matching. This is important. Matching says that we match the revenue and expenses together in the same period. So as we expend money to earn our revenue, so say we pay our salaries to our salespeople as they make the sales, we want to record those in the same period. So what happens if we recorded our sales coming in 2010, but we didn't record the sales salaries until 2011? So we have 2010 that would show really good results, and 2011 which would show really bad results, but we didn't match properly. So what we need to do is put them in the same period, matching revenues and expenses. That's the idea there. Full disclosure says all financial information that is important to decision makers should be included. So even if it's not a transaction, but we know that we have a big lawsuit that's pending, we would want to disclose that in the notes. That's what full disclosure says. A couple of assumptions: going concern. That basically says unless there's evidence to the contrary, unless we know that we're not going to pay our bills, we're going to assume that the company goes indefinitely into the future. Monetary unit says that we're going to record in dollars, or if it was a foreign company, that we're going to record in some different type of monetary unit. Time period says the life of the company can be broken into units. So essentially a company goes from cash input to cash output as they resolve or as they dissolve, but the time period assumption says we're going to break it apart into quarters or years so that we can actually measure this. Without this assumption, there's really no use for accounting. We would just take the cash in to cash out years down the road. But so we assume time period for purposes of reporting. And the business entity says that the individual owner is separate from the business. So if I invest into a car dealership, I'm going to have one set of books for myself and one set of books for the car dealership. We keep those separately. I've listed the three different types of businesses. You'll want to look at those and the advantages and disadvantages. The sole proprietorship is just one person. The partnership is two people, and the corporation is multiple people who buy stock. So the advantages and disadvantages of each. The corporation, real quick, I'll look at those with you. Corporations are the largest companies. There's fewer corporations than sole proprietorships, but they by far earn the bulk of the income and revenue in America. So think about Walmart, Target, ExxonMobil, those type companies are corporations. So they have the ability to generate investment capital, people buying stock. The separate legal status. So that basically means if the company goes bankrupt and I had invested $1,000 into Walmart, the most I can lose is my $1,000 investment. If they have some major lawsuits, some cribs that were broken and some lawsuits over that, some child deaths, example, then I'm not liable beyond my $1,000 investment. But if it was a sole proprietorship and I had made the cribs, then I would be personally liable. Even my assets outside the company could be legally come after. The disadvantages is double taxation. So the corporation is going to report a tax return for their earnings, and as the corporation pays dividends or I sell the stock at a higher value than when I purchase it, I'm going to be taxed on that as well a second time as an individual. And there's also extensive government regulation. So that's what I did at Hastings Entertainment. I did the SEC reporting for the corporation. So those regulations aren't near as strict if you're a sole proprietorship or a partnership as they are for a corporation. There's a little bit about SOX there. I'll let you read that on your own.